and welcome to the Buck Stops here. I'm Catherine Murray. Well, we've certainly seen a very volatile start to the markets, and nobody really expected the price of oil to skyrocket the way it is, which is really changing the potential outlook for inflation, deflation, stagflation. So I'm really thrilled to be able to bring to you today to shed some light on where we might be going. Barry Allan is joining us. He's the CEO of DMAT Capital. He's a fixed income veteran and currently manages funds for Horizons ETFs. Barry, welcome, and thanks so much for joining us and giving us some perspective in terms of what exactly is going on.
Yeah, it's good to see you, Catherine. Always is.
Thank you. I want to first get your take in terms of, everybody's focused on the U.S. 10-year yield, and can the market, the overall equity market, withstand rising yields? But I think you want to probably step back and take a look at what the key driver of the answer is. I think it's the focus on oil.
Right. I think the key drivers of all markets right now is inflation and how it plays out. And in my view, the outcome for oil, which is highly uncertain and highly volatile, is going to drive this. We'll have a very different outcome in markets and inflation if oil retreats back below $80 a barrel, or if problems with the Ukraine and Russia and oil goes to $150 a barrel, which a lot of commodity specialists are suggesting. I think those are two very, very different outcomes. Neither one of them are great. But if oil goes to 150, the outcome for financial markets is dramatically worse than if it retreats below 80.
So right now, just given the fact that you manage money, are you hedging your bets, or are you leaning more towards where you're saying some of the commodity specialists are saying oil's going, which is 150?
Yeah, well, I've had very close to zero or negative duration in our funds all the way through the first quarter. And that's been the right thing to do because we're basically flat on the quarter when the fixed income indices are down anywhere from 6 to 10% in a quarter, which is extraordinarily unusual in fixed income.
Okay, so you've outperformed by keeping your duration, so your time frame very short in terms of anything that you're buying in the fixed income market, just so that everybody understands what short duration means.
That's correct. But, on Tuesday of this week, the entire U.S. yield curve from 2 years to 30 years basically converged at 2.5%. And when that happened, there was a very significant wall of money came in to buy fixed income. That tells me that we're getting close to the top in yields, with the caveat that if oil goes to 150, we're probably will set a new top in yields. But for now, somewhere in the 250 to 265 range is an area where a lot of money is willing to buy fixed income.
What does that mean? Why is that happening?
Well, what it means is all the people that say there is no alternative to equities, the TINA crowd, that isn't correct. That there is a level of yields on U.S. Treasury, the 10-year U.S. Treasury, where people would rather own than buy stocks. And for now, it's around 250.
So 250. So people are willing to put money to work and get 2.50% interest rate. Now, is that because do you think that that's because they fear what might happen in the financial markets because oil might go higher? Or do you think that that it's just an attractive yield to buy in at this point, and they think that we're seeing the height in yields?
I think what they're saying is that the Fed is likely to raise rates to right around 2.5%. And that will slow the economy significantly enough that bond yields will start to fall. and equity prices will probably have declined by that time.
Okay, so we're going to pick it up on the other side of the break in terms of what we really did hear from the U.S. Federal Reserve the other week, and if they might make a policy mistake. We'll be right back. Barry, I want to get your take in terms of what we did hear from U.S. Fed Chair Jerome Powell 2 weeks ago now, or March 16th, I think the date was, when we heard from the U.S. Federal Reserve and what the market was expecting. Because the market's actually been performing quite well, despite that they seem to be absolutely on the path for more rate hikes. I mean, I think he gave a little bit of room to be nimble. I think he basically said he doesn't have to raise rates every meeting. But that the path is to raise rates. Do you think that they will raise rates? Will they do it too fast, and will they cause a recession?
I think they are going to raise rates too fast. It remains to be seen whether they cause a recession or not, but that probably doesn't matter. It's whether the markets build in a recession that really matters to people that are investing and have money exposed to financial markets. But I wouldn't read too much into the equity market activity since Powell spoke 2 weeks ago, because I think there's pretty strong month-end, quarter-end flows that are driving equity prices here. And, the stock market was down over 10%. He came out and said that, and there is a lot of window dressing going on, which has driven stock prices back up to close to flat on the year.
Yeah, and the stock market's rebounded quite nicely. But so I guess so that everybody understands, when you talk about the money flows, it's because the market had pulled back so much. If you're an index fund, you need to buy more equities to balance out your percentage equity versus fixed income. Is that what you're talking about?
Yeah, and I think that you'll tell in the next couple of weeks. I'd be very cautious on stocks in the next couple of weeks.
Why in particular over the next couple of weeks?
Well, because I think it's up. A lot of stocks are up 20% the last 2 weeks, and it's quarter end, and we'll start to see what the bond market starts. So the bond market has rallied too. And if bond yields start to go back up, equity prices are probably going to struggle as well.
Okay. And so, Barry, when we think about oil going to maybe 150 or alternatively down to 80, walk us through what that scenario looks like for the financial markets and inflation.
Well, certainly if it goes to 150, that means, we've got 8% annualized CPI. That means it could go as high as 10%, and more importantly, probably last longer, the way the CPI calculations are done. And so if the CPI rate goes to 10% and doesn't start falling for another 6 to 9 months because of oil, then the Fed is forced to have a more hawkish policy, and pretty much ensures that they will overhike and increase the risk of recession significantly.
And what about the alternative? If in fact there is some type of reprieve in the price of oil and maybe it goes back down to 80, how do you see that impacting the financial markets? And importantly as well for our viewers, the economy, as everybody looks to kind of plan their future.
Yeah, well, then the outlook is probably much more benign. If we do have a recession, it's likely to be shallow, or we may avoid it because the market would probably prove to be right that the terminal rate of the Fed funds rate's around 2.5% instead of 3.5% or 4%, which brings in dramatically different outcomes for the equity market.
And what's your sense right now in terms of the health of the U.S. economy? We'll start there and then we'll talk about the Canadian economy as well. But just in this segment, U.S. economy, what's your sense?
It's pretty good right now, but it's slowing. And you've got an environment where you've got a hawkish Fed, you've got inflation at 8%, oil above $100, high equity multiples, tight credit spreads, an inverted yield curve, supply chain problems, margin pressures, and a lingering pandemic. Those are all the negatives, and the positives are a much shorter list. So based on history, you should be defensive right now.
I love the way you just said it. Just a much shorter list. You're not even giving us the list. Barry, hold on. We're going to take a quick break. We'll be right back with Barry Allan. Okay, Barry, I do want to get your take, though, in terms of what would be the bullish narrative in the financial markets. What's one or two things?
Well, certainly the economy is growing and it's quite strong, and the employment markets are extraordinarily strong. We had jobless claims came out this morning. They were still just barely above 200,000. The previous week was a 50-year low in jobless claims. The unemployment rate's below 4%. The employment environment is very strong. That's highly related to the pandemic and savings rates. Savings rates are high. And if you have high savings rates and strong employment data, you would expect resale sales to be pretty good for the foreseeable future. But I think those things are on negative trends. I think the pandemic ultimately is causing a lot of companies, a very high percentage of companies are automating minimum wage unskilled labor jobs, which take 2 to 3 year process. And I think a couple of years down the road, you're going to see that the employment markets are almost the reverse of where they are now, that they could be unusually weak. And if you have unusually weak employment markets, it's hard to have a strong and growing economy.
Yeah, that's a really interesting and important point that you made to me actually a couple of weeks ago. That and correct me if I'm wrong, that it's not just a supply chain issue with respect to semiconductors, that you've got such increased demand because of these companies through the pandemic really automating their process. In other words, to your point, if I'm getting this right, expect to see much higher unemployment in the next number of years as these companies are actually able to switch to do that.
Yeah, and it's good for the economy, it's productivity. It's not necessarily bad for the stock market, and it's good for corporate margins. But if the labor force participation rate goes from 62% to 55%, that will have an enormous impact on society and on the economy.
Swinging the economy, what's your take on the Canadian economy right now?
Well, the Canadian economy is in a pretty good position because it's tied to commodities, and commodities are, in the strongest price position we've had in 40, 50 years. But it's predicated on the pandemic and a war in Europe, and hopefully both of those things are not long-lasting events. So Canada's economy is very vulnerable. If those things start to dissipate, and if the Canadian dollar was slightly above 80 cents, my kind of thesis, anything above 80 cents, Canadians probably should be diversifying and own some US dollar assets.
When you think about the vulnerabilities, though, in the Canadian economy, obviously commodities are kind of helping the overall economy. But what are some of the key concerns that you have?
Well, housing is the big elephant in the room in Canada. I mean, residential housing markets are extraordinarily high everywhere in the world.
Mm-hmm.
But in Canada, the debt to income statistics are one of the worst in the world. So if we do have a correction in housing prices, which is inevitable within whatever time frame you can guess, to me, especially when rates are rising, then Canadians are going to get hurt worse. And I think that's one of the reflections of the valuations of Canadian banks, which are cheaper than banks around the world, despite being extraordinarily profitable businesses.
Do you think that they're vulnerable then? And that's what their valuations are?
If we have a housing correction, banking stocks are going to go down, yes.
Okay. All right. We're going to take a quick break. When we come back, Barry, we'll get your take in terms of some of the best ways you're positioning your funds right now. We'll be right back. And we are back with Barry Allan. Barry, I think that well, I don't know. I mean, can you ever say it's different this time? My question was going to be, is it more difficult managing money right now?
Yeah, it is different this time because we've never had a pandemic before. And the Fed has never started hiking when the yield curve was this flat and inflation was so high. And there's a whole bunch of precedents, but it all comes back to COVID and the pandemic. We've never had financial markets react to a pandemic before, so it is different this time. But there are a lot of things that rhyme, as Mark Twain said, as well.
And what would that be?
Well, like the yield curve briefly inverted, and out of inverted yield curves comes big bond rallies, because very often an inverted yield curve leads to a recession. And, I've never seen a situation where credit spreads were this tight and equity multiples were this high when the yield curve is totally flat or inverted.
Yeah. And throughout our conversations, and we've been having conversations for so many years now, I always love it when you point out, aspects of the market that absolutely don't make sense in terms of how they're moving together or not. Right. So having said that, though, Barry, I mean, in full disclosure, I've had the benefit of investing in some of your funds when there were, some really unique opportunities. Are there any unique opportunities right now, or what's the best approach that you're using in your funds?
I'm still very cautious and remaining very at the low end of my risk spectrums right now. But I am, at some point, I'm going to extend duration aggressively and be shorting and hedging our high yield credit positions. Because once the 10-year yield peaks, for all the people that say, well, the yields will come down and the equity market and the credit markets are going to be fine, history doesn't support that. Once the 10-year yield peaks, it's peaked because the economy is slowing and the employment data is rising. I mean, unemployment data rising. And in that environment, you're going to have pressure on equities and pressure on high yield credit and investment grade credit too, because there is so much leverage in the world. The world has never been more leveraged than it is now. And
by that you mean governments, correct?
Everybody. Consumers, corporations, and governments are virtually at record high leverage. And there has to be, with deference to the modern monetary theory crowd, which I don't believe in.
Which means just print money forever. That's what that means, really, right?
It does. It says it doesn't matter how much money you print if you only borrow in your own currency. But that is the point. If you overdo it, your currency will collapse, and if your currency collapses, inflation goes up, and interest rates have to go up then, and your economy goes into recession. It's not any more complicated than that.
Mm-hmm. Right. So having said that, then at some point, though, when you see that U.S. 10-year yield, and you've kind of indicated maybe that 2.5% mark, you're going to be going long. You're going to be buying long.
I'll start
10,
at 2.5. I think it could get to 275 or 280. But again, it could be much higher if oil goes to 150.
Right.
That's the real wild card here.
Is the wild card. What are you watching most closely then to try to figure that out?
Well, you look at rig counts and inventory data, and rig counts are rising pretty aggressively, but inventories are at record lows. And the Russia situation is problematic. You can't predict what Russia is going to do and the war is going to play out, and how the impact on energy is going to be.
Okay. We got to leave it there, Barry. Great to see you. Thank you.
Great. Good to see you.